I am Suan Teck Kin, Head of Research at UOB. The ongoing trade tension between the US and China started since the beginning of 2018 and is likely to persist for some time. The impact is being felt in financial markets globally. Equity markets are reacting with concerns and have increasingly priced in more negative impact on revenue, earnings, and demands for goods and services, while the US dollar strengthened as investors look for safe haven and move away from risks. Both Chinese and emerging market stock indexes have fallen sharply since the start of 2018 when the US began levying tariffs on a variety of goods and against China. The US stock markets are also showing declines after reaching record highs in mid-2018. In the currency market, Chinese currency renminbi has fallen against the US dollar in a fashion that reminds us of the devaluation in August 2015, as the US dollar strengthened across the board as risks increased. Based on the US data, in 2017, China exports nearly 4 times as much to the US than the US exports to China. That is, US exports about $130 billion to China in 2017, while importing about $500 billion from China that year. It's because of this imbalance in exports and imports, the US runs a trade deficit of nearly $380 billion in 2017 compared to $350 billion in the year before and nearly double from 10 years ago. The US government under President Trump believes this trade imbalance is unfair to the US and wants to correct this by imposing trade tariff or import tax on Chinese goods. However, the Chinese government also retaliates with additional tariff on goods from the US, hence the trade tension escalates between the two countries. Eventually, as trade tariff rates increase and being imposed on more goods, US producers selling to China will be losing out as other manufacturers try to gain a share of the China's market, which is seeing rising affluence, consumption, and with a large population. This will also mean production costs will be higher for US producers and hence lower profits. At the same time, as more Chinese goods are being targeted for tariff, costs to the US consumers will be higher, which will tend to affect demand. This potential hit on demand will impact on companies based in China, be it domestically owned or foreign owned. Although US has remained consistently one of the most important markets for Chinese exporters, it is China as a market for US products that is experiencing rapid growth since China's accession to the WTO in 2001. We perceive the trade tension and retaliation in trade tariff will be a lose-lose situation for US and China as it drags on. Producers are faced with higher costs and consumers will be facing higher prices. When demand falls due to higher prices, both producers and consumers will be getting less, and therefore a lose-lose situation for both economies. When demand in US declines in reaction to higher tariffs and producers face with smaller earnings, investors should brace for fallout on falling revenue and profits. More importantly, the negative impact on market sentiment and business confidence, as well as uncertainty in business and economic outlook. Investors will need to take steps to diversify and mitigate risk as trade tension is prolonged. How will demand for commodity and resources be affected? What is the impact on economic activities from the trade tension? Meanwhile, companies will be adjusting to the reality of US trade tariffs, which may persist for a longer time, and to lower their risk of being exposed to tariffs. They will look for 1. Alternative locations that may not be subjected to trade tariffs, and 2. Alternative markets that are open and friendly. This makes ASEAN an attractive alternative or supplementary manufacturing base to China and potential market for companies. As the US Customs tightens compliance with rules of origin, trade diversion from China to Southeast Asia and other countries will be followed by investment diversion. China, instead of selling directly, will instead supply components to countries exporting to the US. Mainland electronics companies are relocating facilities to Taiwan so that final products exported to the US are not from China and therefore subject to rules of origins, are not liable to new tariffs. This means that economies around the region will be seeing increasing investment flows from China, the traditional trade and investment partner. ASEAN, with a 640 million population and the 5th largest economy in the world, is itself a large market for many companies looking to expand their reach. China will hold the China International Import Expo 2018 in Shanghai from 5th to 10 November 2018. This is the first import expo in China, will be on a massive scale and a signal to the world. ASEAN, which has a free trade agreement with China, is becoming a major export manufacturing base, not only for advanced economies such as the US, but also for China. The integration of Chinese and ASEAN economy is being hastened by trade and political tensions between China and the US. For every member in ASEAN, China is already the largest trading partner. When Chinese President Xi Jinping announced the Belt and Road Initiative in Jakarta in October 2013, he expressed the hope that China's bilateral trade with ASEAN will reach $1 trillion by 2020. The trade developments, including tensions between US and China, are expected to accelerate the move towards this target from a bilateral trade of around $0.5 trillion in 2017. There will be impact from the ongoing trade tension on companies' revenue, earnings, and market shares as demand declines and producers respond to higher costs. Equity markets are reacting negatively to such a development and risk aversion rises. At the same time, there are opportunities for countries that are not directly affected by trade tariffs and which possess a large domestic market, such as ASEAN. Chinese companies will be looking to diversify their production bases to multiple locations to minimize risk of being affected by trade tariffs. Any adjustments, be it short-term or long-term, will require investments to be made. For example, moving production to a different location in another country will come at a cost that will require investment of capital and time, and often require trusted partners in the investment process. Companies now realize that trade tariffs can be imposed very easily, and there is a need to look for new markets to diversify away from risk of relying on traditional markets such as the US and Europe. ASEAN will be one such attractive market location given its large and young population. As companies explore potential new markets, it is important to work with entities that are well established and trusted and are familiar with local conditions and environment. Businesses themselves need to ensure they have the resilience to manage these fluctuations.